Portfolio Builder members, welcome to our Monday Trade Alert. What a wild week, and I've been warning that Trump was likely to escalate the trade war since June. Didn't get it in July when I thought he would, but now we got it all at once in August. 2 weeks ago, he did a small threat. China decided to give him the middle finger right back, and he lost his temper on Friday. Thankfully, due to our overall strategy, we've actually made a nice profit. Not a big profit, but unlike many people who lost 3, 4, 5, 6% of their life savings in a matter of hours, our portfolio was well balanced and positioned to take the impact quite easily. And so the secret to our success was having essentially an equal allocation in our bonds and a nice position in gold. So that offset the losses in the SPY, plus we had some put options protecting us to the downside. So I'll take a look at the overall strategy, but I do want to point out that our total return continues to grow, and this is what we call a weather-proof portfolio. It's extremely hard to lose money. In general, when the bonds go up, the stocks go down and vice versa, but they're climbing higher together. And I'll look at my big picture view. But let's just look at the SPY trade to start off, and then we'll jump into the total strategy and what I'm recommending people do with their total allocation to weather the US-China trade war. So on Friday, we bought a put option and we did not sell a call option. And that's because I am expecting the SPY ETF, despite all this trade war fears, to climb back to that $300 range or higher. And we'll talk about why, but it has to do with the rest of the world going into a recession and the US being the last safe place to go for a yield. Not only is the dollar most likely going to continue to strengthen, but also the bond market and the stock market, I think, will have a lot of attention as probably the best place to invest, at least in the near term. So with that said, for those of you who are used to us selling call options, expect to not sell any call options until stocks get a little expensive again. I don't want to miss out on $3, $5 jumps over short periods of time and miss out on those profits because we were selling ourselves short with the short call. Now, once we do travel considerably higher, we will tighten up the trading strategy to also take advantage of selling call options. But right after you have these sort of crazy sell-offs, there's typically a huge run-up in the underlying asset. And so just to get to the 300 level, again, we have $13 we can pick up on the SPY, and I think this could shoot to much higher than that. So we'll look at the big picture and go from there. So first of all, we saw the SPY go from 287.22 when we placed the trade. We bought the 286.50 put to protect us. It went as low as 283 in the futures market this morning, or at least Sunday night. It was close to 280. So that 286.50 put was doing us a lot of good. And then we had a big jump this morning, kind of what I expected. So we lost 11 cents on the SPY, and we also lost $1.42 on the put option. And so our net loss was a negative $1.52. And so, it took a little bit of our profit off the SPY, but it's typically after periods like this where we really rack up the profits. So our strategy allows us to mitigate the downside risk, but then also be ready to profit when we get the sharp rebound. And we'll talk about why I think the SPY could be headed much higher in the near future and how this ties in with our bond and gold strategy. Our monthly return is summarized right here. And again, in the Trade Alert doc, you get access to all this. The last few months have been a little bumpy, and that's because, of course, we've been expecting the trade war to escalate, and sure enough, it has been escalating. It took a little longer than I expected, but now that we know it's here, we have been prepared and can take advantage of the situation. And this is while most people are really just kind of suffering and wondering what on earth is going on here. So the trade alert today was to sell to close your 286.50 put, which was providing downside protection over the weekend. Turns out we didn't need it, but for quite some time there, we would have been down an additional $4 to $5. And if things had not gapped open this morning, that put option would have provided its value. Today's trade alert you don't get to see in the live stream because this content is published to everyone. And if you want to get the trade alerts real time, if you are getting this late, call Dean at 505-322-7515 for some special pricing. We'll make sure you get all the trade alerts. But yeah, today's trade is very similar to this one. We're essentially just buying a put option and we're not selling a call option. And that's because I'm expecting a rapid rally in the SPY ETF, potentially all the way into Christmas. I think perhaps the trade war escalation is now over and we'll have a period of easing as we see if these two sides can work something out. Now, I do want to talk about the total strategy and some changes we're making in our buy and hold portfolio. So to get the best results, it's really important to have a equal allocation in your equities as your bonds. Now, we have put options underneath the bonds and underneath the equities so that there's a limited risk in any given trading period. That's what makes our trade alerts what I call atomic bomb proof. But if you're just all in bonds or you're just all in equities, you're not going to get the best result, and you're going to have periods of losing and periods of winning that can make it quite difficult to have a consistent income. So if you have $105,000 that you can put to work, this is the current recommendation. And I will also show what I call the light version, where you only do the SPY and the TLT. And you could do that with 66K. So let's just take a look at the overview and we'll jump into how all these portfolios are working together and what the return is today. Just about 15% return this year with extremely low drawdown. So if you have $105,000 to invest, the smartest breakdown would be 100 shares on our Monday, Wednesday, Friday trade, which is following the SPY. Tuesday, we are aiming to generate much higher returns with a little extra risk. And this is rotating either between silver or a specific stock. So recently we traded Apple. Currently I like Facebook. And at some point, once the stocks do retrace towards all-time highs, I'll be looking to flip out of that on the Tuesday trade from an equity. And we're looking at just the best of the best. We're looking at companies like Microsoft, Apple, and Facebook currently as potential stocks for our Tuesday trade, where we can get a much larger profit on a hand-chosen stock that I believe has the most upside potential for generating consistent income. Now, the 300 shares of TLT is meant to be almost equal to the total value of your 100 shares of the SPY and the 100 shares of our Tuesday trade. Now, currently, we're also recommending that you have 10% allocation into the gold market. Now, as of last week, we were holding GLD and not GDX. So I did sell my GLD and buy GDX. I'll show you those trades in a moment. And we were just following Bitcoin, but now we are recommending a equal weight in Ethereum relative to Bitcoin. And this is because it does look like the tariffs are going to force the Chinese to continue to devalue their currency. This has a ripple effect into countries around the world who will then also have to devalue their currency. And I do believe this will continue to put pressure on the gold market, the Bitcoin market, and we're seeing huge volume push into Ethereum. So while Bitcoin could potentially double from here to get to 20K and would probably have some resistance getting to that level, Ethereum trading at 190 would have to go up to $1,200 to break into its recent highs. So it has the potential for something like a 5-time gain. And so this is our current total allocation per approximately $105,000 in capital being put to work. Now, right now, the SPY is a little less than 30K for 100 shares, and Facebook's a little less than 20K. So you're probably coming in right around $100,000. Now, if you don't like crypto coins, cryptocurrencies, you could just replace the Bitcoin and Ethereum with extra shares of GDX. Now, let me explain what GDX is. That's the mining ETF for gold miners. And so previously we were holding GLD, which is a product that represents spot price of gold. It's now become quite clear that they are not going to kick the can down to 2020 and de-escalate the trade war. So I'm expecting there to become a long-term demand for gold, which means our gold miner ETF, GDX, could double, triple, or even quadruple in the next year or two, as long as this pressure is continuing to rise, which is where the core currencies, the Chinese currency and the euro, devalue, which is causing a ripple effect into all the emerging markets. And essentially we're getting inflation worldwide, which is causing people to look for alternatives. Those alternatives are the dollar, gold, and crypto. And so now if you want to do a little bit easier schedule with a smaller total size, you can leave out the Tuesday trade. It's very similar to the SPY, just going for extra risk and extra profit. And here's how your breakdown would look. So if you only had $66,000 to invest and you only wanted to do the SPY trade Monday, Wednesday, Friday, and then the bond trade on Thursdays, you'd have 100 shares of SPY, 200 shares of TLT, and then you'd still want about 10% of your assets being in the gold and digital money. So that would turn into 150 shares of GDX, 0.075 Bitcoin, so that's about $750 worth of Bitcoin, and then 8 Ethereum coins, that's approximately $750 as well. And so I believe this portfolio is what we call weatherproof. We're not going to win on all aspects of the trade in each trading period, but when one is weak, the other is strong. And combined, this has had a very powerful return. So if we do look at our total return, we're at 14.79. If you look at the combined returns of all these assets combined together, we've only had one losing month, and that's in July. August, we're having a great month, 1.3% return, because that bond and gold portfolio is really coming in strong as Trump raises the tariffs. So that's the breakdown on that. What I'd like to do now is go look at the trade alert one more time. So at the bottom of the email now, I have a summary of your trade schedule with the breakdown, including the Tuesday trade. Now, if you want to skip the Tuesday trade, that's easy. Just remember, for every 100 shares of the SPY, you want to have 200 shares following our bond portfolio. And we have a breakdown of all the track records for you in the daily email, so you can check that all out. And here's our current allocation in our buy and hold gold and cryptocurrency portfolio. I do want to note that this is really up 200%, but I've been adding and adding and adding to it as this trade war has escalated, and the central banks have really shown their true colors as to their intentions, which is to lower interest rates, print money, buy up government debt. And this is going to cause most likely just about every asset out there that has some legs under it to rise. Now, I have optimized this part of the portfolio to be prepared to take advantage of volatility to the downside in equities. So we're not in these positions currently, but I do want to point out that I did sell my GLD and replace it with GDX, which is a 75% allocation. And then instead of just being long Bitcoin, we're now having an equal weight of Bitcoin and Ethereum. Now, surprisingly, despite all this news, we haven't seen a huge run up in those assets, but I do think it's in the works. And so we have 25% of our total capital in Bitcoin and Ethereum split equally. And then we have 75% now in GDX. So again, GDX only has strong rallies if investors have the belief that there's a long-term demand for gold, not just a sudden spike. And so that does seem to be what's shaping up here. Now, once we do see the U.S. equity market get to new highs potentially, which is what I really think will happen due to the FOMC meeting, where I think they will drop rates 50 basis points, and that could spur some tremendous run-up in the U.S. equities. We have the potential to rotate into a short position on China and the QQQ and the Dow. So it's Yang, SQQQ, and SDow will be the ETFs in our buy and hold portfolio, where we can try to take advantage of downside moves in the equities market with relatively easy money management. So I'll be covering that daily, what's going on in our buy and hold portfolio. And again, this is totally outside of our income trades, where we do the very careful strategy on the SPY Monday, Wednesday, Friday. The Tuesday trade is a specific equity, and again, it's optional. Right now it's Facebook. And then Thursday, this is the one that you really should not skip. This is the TLT, the US bond market. And again, we put a put option below all of these assets on the Monday, Tuesday, Wednesday, Thursday, Friday trade. That represents 90% of our total assets. So no matter what happens, we cannot take a big hit. Currently on the TLT, it is at all-time highs or bubbling right around there. So I've been selling call options and buying the put option. That's the caller trade. And that's a great way to generate income safely on this part of our portfolio. Now the equity portfolio, I am not selling call options right now because we just had a tremendous sell-off, and I'm expecting a rapid push back to new highs as people start to get the big picture. And the big picture is simply this. China GDP is crashing and heading towards a massive recession. Germany is their biggest trading partner. It's already on the brink of recession and has negative interest rates. And so there's really nowhere to go for yield in the entire world outside of the U.S. products. Emerging markets won't work because the U.S. is applying so much pressure that most likely they're all going to go into a recession. Their currencies are devaluing because China is devaluing their currency, and that's their primary trading partner. So that's pushing capital into the dollar. And as all these countries are forced to essentially print money to pay off their US dollar denominated debt, that's going to make the value of equities and US bonds rise. So until we see a major deterioration in the profits of the key companies in the SPY, I'm expecting all U.S. products to travel back to new highs. And I think the only thing that will really upset the equities market would be, of course, retaliation from China on the U.S. trade war front, or if we actually saw the earnings start to deteriorate. But on the other side, Trump is not trying to balance the budget at all. So this means the government will continue to have huge deficits, which makes our GDP look strong. Think about it. If we have a huge deficit of capital flowing into the U.S. government, that flows into the economy, makes our GDP numbers print really high. The tariffs are causing people to try to front run it. So I don't think we're going to see a breakdown in earnings in the U.S. companies that are driving the SPY much higher. And in the same note, what better time to create a huge deficit than when interest rates are on the way towards zero. So I don't see anything really breaking in the U.S. economy currently, and that's why we want to not shortchange our potential profits on the SPY after we just weathered that Trump trade war escalation. Okay, so now what I'd like to do is jump into our content. This document is linked to in the description box. So if you want to get a copy of it, you can just go click in the description box and come over here to the spreadsheet. And again, for those of you who are getting the content delayed, or if you're just getting our SPY trade alerts and you want to get the rest of them because you only bought the basic membership, call Dean right now, 505-322-7515, and get special pricing to get the whole product in one swoop. Okay, so let's take a look at what's going on, and then we'll wrap up today's live stream. So this is the core stocks I'm following. And you can see everything's in the green today. TLT had a mild sell-off, but the TLT has been really one of our best positions all year. Here's a look at the SPY, having that sell-off, getting to this critical support level. If it were to break, it could go much lower on a technical analysis basis. So that's why we're continuing to buy the put option. But I do suspect everybody's going to put together the pieces here. Number one, there's nowhere to really invest in the emerging markets or in Europe. It's all a mess. They're going into recession. Their GDPs are crashing. Their bonds are going into negative territory. So there's really absolutely no competition worldwide in terms of currencies, in terms of equities, or in terms of yield from bonds. So the only reason you might be investing in an international bond right now is if you're trying to go for a quick flip because you think that yield's going to crush even lower. But if you're actually trying to generate some sort of return, like most bond investors normally do, the U.S. market now represents 95% of all positive yielding sovereign debt. Add to the mix that the Federal Reserve is most likely going to start dropping U.S. rates and buying up its own treasuries. In fact, in this report, I'll show you they actually did that last month. That's extremely bullish for U.S. equities. So I wouldn't be surprised if this doesn't just break past 300, but climbs substantially farther than that in this current climate. Here's a look at the TLT. It's where we generated quite a bit of profit yesterday or Friday after the surprise Trump tweet. Here's a look at GDX. So we did get out of GLD. I like GLD when we weren't quite sure if the trade war was going to escalate. Now it's extremely clear. So we've rotated into GDX and out of GLD. FXI is the large cap Chinese ETF. We were buying put options on this. But I've decided to make the Monday, Tuesday through Friday trade alerts extremely simple and only trade one ticker at a time. So rather than trying to buy puts on FXI or call options on gold on top of our callers, we're going to get you out of those for a profit, hopefully. And we have pulled off some 100% gains on FXI. But in the future, if I want to go short China, I'm going to be using our buy and hold portfolio to pick up a big position in the ETF Yang, which is a bearish ETF that accomplishes the same thing as buying puts, but it's a little bit easier to manage. Here's the Russell 2000. This is giving us a better indicator of the true health of the equity market. Clearly, it's still weak. But if we were to see this break past this level right here and start heading towards that 173, that could be extremely bullish for the stock market. I like Facebook for our Tuesday play right now. It has an absolute monopoly in its space. It's quite likely going to have a record profit in Q4. It just got over a $5 billion fine. And they're creating a new currency called Libra that really solves the macro picture that we're going to be facing for the next probably decade, which is all these governments that are starving for money. They've made all these promises to their populace that they can't make. So this is going to cause all these governments to essentially have to buy up their own debt through their central bank, increase the monetary supply, which makes the buying power of every dollar, of each currency lose value. And so their solution, in my opinion, is better than the dollar. It's far better than Bitcoin, and it's far better than gold. So I really like the outlook for Facebook over the long run and intend to play it anytime it has a sell-off on our Tuesday trade. It's also insulated from the US-China trade war. I did like Apple for quite some time, and we made some good profits on it. But now Apple's facing the dilemma of having to move its supply chain from China. That could be quite costly. So I do like Apple on dips, but they may have some serious problems ahead. Now, it is nice that US is stabbing Apple's competitor Huawei in the back. So really now it's just Samsung is their core competitor, if they can really put some damage in Huawei. This is the chart I like to look at for kind of a warning sign that the US equity bubble may come to an end. LQD, investment grade bond ETF. This essentially tells us that the big companies that are at the top of the pie have access to cheap capital, which they're using for corporate buybacks. So until this cycle of taking on debt and using it to buy back your own stock is ended, it's going to be hard to crash the U.S. equity market, especially when we're headed to near zero rates. So this bubble could get much bigger than it is currently. This is perhaps the most important chart of all. This is the Chinese currency converted into the dollar, and you can see their solution to offset the tariffs is to give you more of their currency for the same dollar. This means the importers of Chinese goods don't have to really pay the tariffs because they're getting a better conversion rate to the dollar. Now, this has a ripple effect that I think will be very bullish for U.S. products because it's going to cause other emerging markets to devalue. And if there's more currency out there, represented by some $260 trillion of debt worldwide, well, if that continues to expand, it's going to make the relative dollar figure on equities, which is not expanding, there's still the same shares as there was yesterday, rise. So that's why I'm currently very bullish on the whole set of U.S. products. And so very critical to watch what the Chinese do. Now, if they didn't do that, that could be a huge heap of trouble for importers in U.S. Plus, it would potentially cripple the Chinese economy because all of a sudden their exports would shrivel up. So this is the logical move on the Chinese to offset the cost of tariffs. But that's also what's causing the huge flood into gold, Bitcoin, the dollar, and making our whole trade setup work right now. It's also important to compare the other major currency, the euro, which is continuing to lose value against the dollar as well, which also supports our current setup, which is essentially long all U.S. products. As far as trying to predict yields for the bond market, they go and say a whole lot of stuff at the Fed, but the reality is they've been closely tracking whatever Germany's been doing, which is closely related to what China's doing. And so clearly the German yield is now in negative territory. It had a little bounce there, but I'm imagining that it's going to go even lower because all these problems are starting to get bigger and bigger very quickly. And so now you have to actually pay Germany to have the right to lend the money. So people doing this are just doing it because they think the government's going to be forced to maintain this yield to support their bond market. And if the yields were to snap up, all of a sudden they could lose all their funding. Everybody's going to mass exit all these bonds. It would be a disaster. So it does look like the bond market's somewhat forced right now to continue to push rates lower and to start supporting their bond markets, which will increase the monetary supply, and all very bullish for our strategy. Two other charts I'm keeping a close eye on. One is Deutsche Bank, German bank. If we saw this starting to seriously crack and go below 6, I would become very skeptical of everything. We'd probably get rather bearish on the stock portfolio first and then look out below in the bond market. Most likely, equities will crash first, then the bond market when this bubble does pop. But I think we're quite a ways away from that right now. Another bank I'm looking at, a European bank, HSBC, there's rumors that they were the ones propping up the Chinese currency, and now that deal has been reneged. So a lot of interesting drama going on with this, lots of high-ups being fired, and at the same time we're seeing the Chinese start to lose control, potentially, of their currency peg. As far as what the heck's going on in the trade war, I think it's just the same as always. Chinese are just going to do as little as possible, say as little as possible, fight back as little as possible, and just try to survive this period of time. It looks like they're really, quite frankly, happy to decouple with America and to try to take over the Eurasia land area, and that they don't want to stop cheating and stealing and ripping people off because it's become extremely profitable for their country. And that's really their cutting edge, is that they have communist government. They can subsidize key markets, which gives them a huge competitive advantage in the world and allows them to focus their energies and efforts in core segments of the economy that they think they can outperform. And so with their government structure, that really is their advantage. And unless they wanted to give up the CCP and democracy, turn into a democracy, I don't think they'd be able to compete with a capitalist society, with individual companies. So I don't see them changing their government structure or giving up their strengths. So we'll just see how nasty this trade war can get as all of this progresses. Stocks jumped on some sort of comment between Trump and Steven Mnuchin this morning that China wants to talk again, that they're scared. Of course, China's coming out and saying, "What? We don't want to talk." So here's the quote from that. Meanwhile, China is facing some major inflation. In fact, I think most of the world is starting to see inflation. That's what really can pop the bubble here for everyone, is that as soon as inflation gets out of control, these central banks are going to have to cut off the free money, raise the rates. That's going to pop the equity market and the bond market, and potentially enter into a considerable depression area of time. And so Ray Dalio has been talking about this for quite some time. He believes that the dot-com bubble and the '08 bubble were small cycles, 10-year cycles of credit, and that now we're headed into a 40 to 50-year longer wave cycle, which is where all these governments who've created too much debt have to figure out some way to pay down the debt and make things manageable. This is typically what happens when the wealth inequality gets out of control, rent gets high, income's low, people are pissed. We're seeing it all around the world. We've got protests in Hong Kong, Taiwan, got the Yellow Vest movement in France, and we've got crazy people in America shooting people up. And I think it's really just due to the economic stress that is being applied to the world, primarily to people that just can't afford their rent, their health care, or their education, as their income remains relatively flat. So you can just see the pressure causing populism around the world, not just in the U.S. Some more tweets on the China trade war. Most likely, I think that this will just continue as it is. This is perhaps one of the black swans that could expedite popping the bubble quicker. And that would be if China were to violently come into Hong Kong to end these protests. And so we've got the protests just getting out of control. I've got clips of, they got these little poles out there trying to beat the cops down. The cops are pulling out guns now. They've got fire trucks squirting people with water, high-powered water. We've got people breaking down the spy cameras. So in China, they have facial recognition software that can pick up your face, give you tickets without even a cop being there. And so they're pulling down these poles and burning them. And here is perhaps one of the more interesting, right there. Officially, the Fed has started buying up treasuries. It put $24 billion into the 7-year, 10-year. And so I think QE is back on track. Rates are going lower. They don't want to say it and scare everybody, but that does seem to be what's happening. And typically during, at least in the short term, when this happens, it takes pressure off the bond market. Money flies into the stock market. Call it the PPT, the Plunge Protection Team. So there we go. Or rather, it's $8 billion that was flowed into the Treasury market after they're supposed to be in the tightening. So it does look like they are now done with QT and quite likely going to start ramping up bond purchases to support the equity market as we go to war with China. Here's the interest rates in the developed world. You can see it's negative. Only places you get a yield now are some tiny countries, UK, Australia, New Zealand, Canada, and the US. So there's really no competition for US equities. This is some bricks. Now that people in Hong Kong are throwing bricks at the fire trucks, it's getting crazy. Jeffrey Gundlach making fun of Joe Biden again. Kyle Bass has been talking about this for years. He's having the time of his life. Finally, pressure on China. So there's a little tweet from him. Corporate buybacks, stronger than ever. And with rates going lower and lower, they're going to be able to buy for cheaper and cheaper. So unless the earnings slow down, I don't see the corporate buyback slowing down. And if the government is creating more debt than ever before, that's going to goose our GDP stronger. And plus, we have no competition with the rest of the world for either the bond market or the equity market. Most of the big companies you can invest in worldwide are just big banks. And the big banks struggle with low interest rates. So our tech sector in the U.S. is somewhat protected and insulated from the pressures of the low interest rates that the rest of the world is suffering from. Over the weekend, trade deal with Japan came out. Trade war may be at a stalemate from here. Trump has placed tariffs, much like China has done for decades, on select industries. I see little probability that we see further tariff increases given remaining target flow to U.S. consumers, hence Trump's call for divestment. From here, we probably see more political touch points, Taiwan arms sales, Hong Kong commentary, but the easy parts of the trade war have been exhausted by the U.S. So here is the divergency of the bond market and the Fed funds rate demanding that they start to drop rates. So we'll see if they come through. Now, if they do not lower rates by probably 50 basis points in the September 18th FOMC meeting, that could piss off all U.S. products from bonds to stocks and gold. So that's something we're carefully watching. We have gotten past what I expected to be the first set of hiccups, which was China's retaliation and how the U.S. would respond. So we did get through that. So I do suspect we could potentially have a pretty easy set of months coming ahead with everything just floating higher on the expectation of essentially free money everywhere, or almost free money in the U.S. Now, if we wanted to see more volatility in U.S. equities, I think it would happen if Trump did continue to escalate. So we'll see if China wants to throw any more punches back. I would suspect they don't. But if they did, this is potentially what Trump might do in response. Trump could treat China more like Iran and order sanctions, which would involve declaring a national emergency under the 1977 law called the International Emergency Economic Powers Act. Once an emergency is declared, the law gives Trump broad authority to block the activities of individual companies or even entire economic sectors. So Huawei still has this delay where they can use the Android platform and they can buy the chips from different U.S. companies. If we were to cut that off, Huawei could potentially be out of business in the next 12 months because we have too many critical parts and software that makes their phones work. And that phone company has some 2 billion phones out there, something huge. So that one little piece could be critical in terms of escalation that we'll have to keep close eye on. And that's why we want to have that put option. Here's a joke that Trump is using Nixon's playbook from that same Longview guy. I call it the madman theory, Bob. I want the North Vietnamese to believe I've reached the point where I might do anything to stop the war. We'll just slip the word to them that, for God's sake, you know Nixon is obsessed about communism. We can't restrain him when he's angry, and he has his hand on the nuclear button. Okay, so he's just trying to joke that Trump is trying to come across as unpredictable and too much of a threat for them to continue to escalate with. So we'll see how it all plays out. Right now, we did generate a tiny profit from the total portfolio with the trade war escalation because we had the foresight to have a big position in the TLT and a decent position in the precious metals. Without any sort of escalation, I think we're going to have a nice ride on the SPY, but I just don't know when the next escalation is going to hit. That's why it's so important to allocate your capital the right way. We have really two options for you. If you want to follow our trades 5 days a week, it's a 2-minute trade at noon Eastern. Here's how I would take 100K and break it down. 100 shares in the SPY, Monday, Wednesday, Friday. That costs 30K. 100 shares on our Facebook trade Tuesday. That's optional if you want to skip it. But if you did take the Facebook trade, you'd want to have 300 shares in the TLT. That gives you an equal weighting of equities to bonds. Remember, when one goes down, the other goes up. In general, we're expecting both of these to go up as this trade war escalates. Buy and hold. We got out of GLD. Now we're in GDX. That's the mining ETF instead of the spot price. As long as there's the thought from investors that there will be a long-term demand for gold, GDX is much more lucrative to own. And now, instead of just owning Bitcoin, we're also recommending an equal weight in Ethereum. Ethereum's kind of like the silver to gold. And so I did leave out silver. I like the gold mining companies. They're also highly correlated to the silver mining companies. A lot of the silver mining companies just switched over to gold because they couldn't make money with silver. And so if you look at the grand scheme of things, Bitcoin and Ethereum are super risky. They're tiny market caps. They can easily be flung around in either direction. So we don't want to have a lot of risk exposure to it, but we do want some going into a world of negative interest rates, free money around the world, and trade tensions causing currencies to devalue. Now, if you want a little bit easier schedule, you can leave out the Tuesday trade. And here's how you would divest a $66,000 portfolio. You'd have 100 shares of the SPY, 200 shares of the TLT, and then your buy and hold portfolio. You'd still want a 10% allocation to that. which gets you at 150 shares of GDX, 0.075 Bitcoin, or about $750 worth. And this is actually a little bit more. This is more like 7,000 in that buy and hold. And then you'd want to get 8 shares of Ethereum for another $750. Quick reminder before I let everybody go today, we have the paid member only webinar Wednesday at 1 p.m. Eastern. And we have our freebie webinar Thursday, 1 p.m. Eastern. And again, if you want to upgrade because you're getting only part of our trade alerts, or you're getting it after the bell because your free trial expired, call Dean right now at 505-322-7515 for special pricing. Thanks again. New trade alert tomorrow at noon.